Fears over the Delta variant of COVID-19 are sparking a lot of discussion about more economic lockdowns. But does a resurgence of COVID-19 mean a return to a 2020 economy? We take an in-depth look in today's Fastest 4 Minutes in Finance. Hello, once again, I'm Scott Inman. Well, in Arkansas, we've been all too familiar with the Delta variant of COVID-19. It has been sweeping across other states now, too, and now makes up an overwhelming majority of new cases and new hospitalizations in the United States. It is very possible that it could have an economic impact. But the experts at LPL Research believe it won't be anything like what we experienced last year. Their view and ours is that government-imposed restrictions, which can hurt economic activity, are not likely to come back to the degree they were enacted in 2020. And the main reason for this can be seen in this chart. While there definitely has been an uptick in COVID cases, as indicated by the light blue line, the death rate has not increased significantly with it. That's shown by the dark blue line. In fact, deaths from COVID remain near the lowest level of the pandemic, despite the uptick in cases. Now, one death, of course, is too many. And in Arkansas, we've seen the strain on the healthcare system as well to deal with the hospitalizations. But nationally, the measures in place to contain the COVID-19 pandemic are much more robust now than they were a year ago. In other words, we have more weapons that are fighting it. The lower death rate can be contributed to the vaccination rate. We have several available of those vaccines, and they can reduce the risk from the variant, although certainly not eliminating it. Treatments have improved for those fighting the virus, and we also now know that the virus is not easily transmitted by touching surfaces. That should limit the need for government-imposed restrictions on the level that they came a year ago. But there could still be a drag on the economy and the markets. They would likely come from a few key sources. A big one is individual behavior. Consumer spending drives the economy, we know that. And if Americans have a renewed fear of the virus, they could do less and spend less. We could also see an extension of the supply chain disruptions, which has sparked higher inflation rates. That's because, in other countries, where access to the vaccine is lower, government-imposed restrictions have been reinstituted, and that could limit production of goods that are in demand in America. Continued supply shortage could create more inflationary pressure. However, there are also reasons to believe the markets may move higher. Vaccination rates are rising again. Nationally, 70% of U.S. adults have received at least one shot. Europe has been battling the Delta variant longer than the U.S., and that continent seems to be turning the corner, showing a possible containment of the virus. Bottom line is, we should expect more volatility in the markets as the daily COVID updates come. It could cause a market reaction or even a correction. But LPL Research maintains that it should be seen as a buying opportunity when that happens. The team is keeping their 2021 growth forecast of between 6.25% to 6.75%, and we believe the markets will be higher by year's end. Thanks for watching.